What's up guys, welcome back to InvestingPH. Now with the Philippine market climbing a bit, some stocks on my watch list still haven't moved and even dropped in price, which for a long-term investor like me is a good buying opportunity. So for this video, I will share with you 5 undervalued stocks on my watch list that have strong financials. So let's not waste time and head to the first stock, which is Costco. Now Costco owns 49% of Pure Gold, which in turn gives them ownership of SNR as well, which is a very popular retail store here in our country. And not only that, I think most of us know most of their holdings, office warehouse, and their liquor businesses as well. As to how well they're doing financially, revenue is doing well, growing consistently for the past years. Although there are some small negative growth during the pandemic years, they are still doing okay. As for their net income, for the past years, they are consistent in their growth every year. Now, if you notice, for 2019, they had a sudden increase in growth, which led to a massive negative year in 2020. But this sometimes happened to companies wherein they had a one-off gain during that year. In Costco's case, the gain came from their sale in their equity interest from liquid gas. So without that, they have a consistent overall growth year after year. The only negative income came from 2017, which is a small negative 0.05%. Overall, their 9-year compounded growth rate for revenue is 15.65% and net income is 11.42%, which is a very good growth rate. And as to how well they're converting net profits from their revenue, they're consistent in the range of 3.2 to 3.6%, which is a very common net income margin for the retail industry. And for the company's equity, their equity has a steady growth for the past 9 years, growing at a compounded rate of 8.71%. So even with the pandemic, this company wasn't that affected and still maintained a good balance of their assets and liabilities. This can also be seen in how they manage their debts. For their debt to equity, they only have a ratio of 0.70, meaning they only have 0.70 peso of debt for every 1 peso of equity, which is really good. And this can also be seen in how they are handling their short-term obligations or short-term debts. Their current ratio stands at 6.57. So they have 6 times more assets for every liability, which is a very healthy balance sheet. Now there is one downside to a very high current ratio. This may mean they aren't using well their assets, but in Costco's case, we can see the company growing well their earnings every year even amidst the pandemic. Moving to their dividends. So even here, they don't fall short for dividend investors like me. Since the stock price went down, their yield also went up, having a dividend yield of 3.72%. Which is good even for dividend investors, and they are consistent in their payout. For my buy price, my computed intrinsic value is 7.50. With a 30% margin of safety, my buy below price is 5.25. Now I would also want to show another valuation which is from Simply Wall Street. Their analysts say that for its price right now of 4.29, Costco is 69.6% undervalued from its fair value of 14.10. Now you can look this up on Simply Wall Street. Just click on the link down below if you want to sign up. And if you use my link, by the way, you get a 14-day free trial of all their platform's features. And that's not all. If you use my link to avail their subscription, you get a 30% discount. So grab that opportunity now. Anyway, the next company on my list is MegaWorld, one of the largest real estate companies here in our country. Now like all real estate companies, their price was really hit hard by the pandemic. For their financials, their revenue pre-pandemic was growing smoothly. Though there are some years that they had a slight negative due to the one-off gain from 2014, overall, pre-pandemic they had good growth. For their net income, we can see a massive one-off gain in 2014, which caused a big negative growth in 2015. Now in 2020, we can see their earnings were cut really hard, with a negative 44.87%. Although in 2021 and their latest 12 months, they are close to recovering their pre-pandemic earnings, which is really good. So with that, their 10-year compounded growth for their revenue is 5.19% and their net income is 6.97%, which is not bad. This is with their earnings haven't yet recovered. And for their net income margin, they are maintaining it in the 22 to 26% range, even actually growing it to 28% this pandemic. Now for their equity, they had been consistent in their growth, growing at a good rate of 11.05%. And as to how well they're handling their debts, their debt per equity is only 0.82, really low. They only have 0.82 of debt for every 1 peso of equity, and this can also be seen in their current ratio, which stands at 2.92. With this, they're handling well their liabilities. That's why I'm confident enough to keep on investing in Megaworld even during the pandemic. Moving to their dividends, although they are consistent in their payout, their yield is quite small, only having a dividend yield of 1.83%. It only got this high due to its price plummeting. And for my computed intrinsic value, it is still at 5.09, and with a 30% margin of safety, I have a buy below price of 3.56, and for Simply Wall Street, the analyst consensus fair value is 4.27, which means for the price right now of 2.31, Megaworld is 46% undervalued. The third stock for today is another real estate company, Ali, another very popular company in the Philippines, and this company had been around for a very long time. For their financials, their revenue had been growing well pre-pandemic, but like all real estate companies here, their revenue dropped significantly during the pandemic. This can be seen as well in their net income, which dropped massively by 73%. Now, although they already had positive growth in 2021 and in their latest 12 months, they're still far away from their pre-pandemic earnings, not even halfway there. With this, their compounded growth in revenue is only 6.34%, and for their net income, 4.67%, which is still not bad considering they are nowhere near pre-pandemic earnings. For their net income margin, their margin dropped significantly during the pandemic season, although their normal average is quite lower compared to Megaworld, which sits at 20% plus. Moving to their equity, they had been consistent in their growth for the past 10 years, even amidst the pandemic. Although it slowed down quite a bit, it's still better than a negative growth rate. With this, they have a compounded 10-year growth rate of 11.35%. As to how well they're handling their debts, their debt-to-equity ratio sits at 1.98, which means they have 1.98 peso of debt for every 1 peso of equity. So slightly near my maximum comfortable range, which is at least below 2. And for their current ratio, it sits at 1.58, still okay since they can cover all short-term obligations. Now for their dividends, same as Megaworld, they are consistent in their payout, but their yield is quite low. Their dividend yield is only 0.94%. For my computed intrinsic value, it's 53.85. With a 30% margin of safety, my buy below price is 37.65. And for the analyst consensus of Simply Wall Street, for its price right now of 28.4, it is 37% undervalued from its fair value of 45.07. The next company is MPI. Now their holdings are all highly moat companies, because these are companies people need in their daily life. First, toll roads, power which is through Meralco, water business from Maynilad, and Metro Pacific Water, and their other holdings, hospitals, light rail, waste management, real estate, etc. For their financials, their revenue is somewhat doing well. Although there are some stronger years, in the long run, it's progressively increasing. But for their net income, we can see the huge effect of the pandemic, cutting their earnings by negative 80%. This is because of the work-at-home setup, which cut their electricity earnings from corporate buildings. And toll roads and light rails weren't used that much because of the lockdowns, so a lot has affected their businesses. Although in 2021 they recovered quite well, they are still far away from their pre-pandemic earnings. Now in 2019, they also had a one-off gain, so even accounting the negative year after that, their 10 years compounded growth rate for their revenue is 5.20%, and for their net earnings, 4.56. Though quite small, it's a given due to the effects of the pandemic in their business. For their net margin, they somehow average between 23 to 25%. 2019 was high due to their one-off gain, and in the pandemic years, it went down hard. But on the brighter side, they managed to get back to their normal average in 2021. For their equity, they are consistent in their growth for the past 10 years, growing at a compounded rate of 9.62%, which is quite good. And as to how well they're handling their debts, their debt to equity is 1.83. So they have 1.83 debts for every 1 peso of equity, which is still in the typical companies. And for their current ratio, they have 1.12 pesos of current assets for every 1 peso of current liabilities, which is still acceptable. They can still manage well all short-term obligations. Although quite in the low bracket, I'm not worried to invest in it because of the nature of their business, wherein people need their service to live. They have a good amount of cash flowing in, For me, MPI is one example of a switching mode. Just imagine, no matter what you do, you are bound to use their service. You can't easily switch. In fact, you don't have anything to switch with. In Metro Manila, you have to use Meralco's services. You can't leave them. You need electricity. And for their other business, you need their water. You need to use their toll roads to go to this place. The only way not to use their service is when you go off-grid using solar panels and rainwater catchment your whole life, which I doubt most of us can do or will even dare to do. Anyway, moving on. For their dividends, MPI pays their shareholders consistently every year. They have a dividend yield of 2.96%, which is not bad even for a dividend investor. And just a quick fact, MPI not only is in the main PSE index, but is also part of the PSE dividend index. Now for my buy price, my computed intrinsic value is 6.42. With a 30% margin of safety, my buy below price is 4.50. And for analyst consensus of Simply Wall Street, for its price right now of 3.79, it is 32.7% undervalued. The last company for today is Security Bank. Just like real estate companies, bank stock prices in our country fell as well, and Security Bank's price after being removed from the index slightly fell even more. For its financials, we will look at different things, since bank financials are different from other sectors. First off, their revenue. Now I put this side by side with their revenue after provisions to see why most banks' net income plummeted during the pandemic, since they set aside a larger provision to cope with unpaid debts, which in the peak of the pandemic is a common scenario. So we can see in 2020, even though Security Bank posted higher revenue, but due to larger provisions, they ended up with a negative growth. This can also be seen in their net income. 2020 had a huge drawback, even though revenue pre-provisions grew significantly. Though in their latest 12 months, they've now passed their pre-pandemic earnings. Let's see at the end of 2022 if they can maintain it. With that, their 10-year compounded growth rate for their net income is 7.20%. Next up, their equity. They had been consistent in their growth every year, though still at a slight negative in their latest 12 months. This may still change at the end of 2022. So for their 10-year compounded growth rate, it's 13%, which is a good growth rate. Next, since looking at debt ratios for banks isn't a good option, since cash deposits are considered a liability, which in turn exaggerates their debt ratios a lot, what I look at is their loans to deposit ratio. This lets me assess a bank's liquidity by comparing the total loans they give to the total deposits. Too high of a ratio for this may mean the bank may not have enough liquidity to cover any unforeseen fund requirements, and too low may mean the bank isn't using the money they have to good use, which in turn may cut their earnings. So usually the typical ratio for this is 80 to 90%. So for Security Bank's case, they have an 86% loans to deposit ratio, which is well within the typical ratio. Next is their price to book ratio. For Security Bank, they only have a price to book ratio of 0.53. So we are buying Security Bank's equity at a huge discount. Now for most bank companies, their price to book ratio is still trading below 1. And for their dividends, they're consistent as well in their payout. They have a dividend yield of 3.41%, which is a good yield even for dividend investors. As for my buy price, my computed intrinsic value is 141.67. With a 30% margin of safety, my buy below price is 99.17. And for analyst consensus, their fair value is 122.85. And with its price today of 87, it's 29.2% undervalued. So with that, this ends this video for today. Now I've shown as well the computed fair value of Simply Wall Street along my own computation to have a different guide. For me, whenever I look at Simply Wall Street's fair value, I still put a 30% margin of safety from it. Anyway, it's all up to you what margin of safety percentage you will use, whether it's from your own computation or if you get it from other sources. So if you find this video useful, before you leave, be sure to click the like button. Thank you and see you in the next video.